Welcome back to Let's Invest with the ASX. In this video, we will explore the importance of having an investment strategy. Time and volatility. Long-term focus helps mitigate the impact of short-term price fluctuations on investment returns. Avoid making hasty decisions based on short-term market volatility by prioritizing your longer-term goals. By staying committed to your long-term investment strategy, you can achieve more stable and consistent returns. Keeping perspective on the bigger picture helps navigate through short-term market ups and downs and make informed decisions. Long-term investment horizons provide the opportunity to ride out market volatility and capture the benefits of compounding growth. Speculation. Speculation involves taking significant risks in the hope of achieving substantial short-term gains. It often focuses on exploiting short-term trading opportunities. By limiting the role of speculation, investors can mitigate the risk of significant losses and prioritize long-term wealth creation goals. Dividends. Dividends can reduce overall investment volatility. Including well-selected higher-yielding stocks in a portfolio can lead to steady or increased dividend payments over time. Steady or increased dividend payments contribute to overall investment returns. Rates of return over time. The timing of entering the market significantly affects investment returns. Buying assets during a market downturn can lead to higher returns compared to buying during a market peak. Confidence in the recovery of low-priced assets is crucial when aiming for higher returns. Comparing rates of return requires knowing the starting and end points. Timing the purchase of investments during a market pullback can enhance investment returns. Market corrections, profit-taking, or temporary weaknesses may present buying opportunities. Buying on weakness is a strategy to take advantage of temporary price declines. Purchasing shares at a lower price allows for acquiring more assets. Holding more well-performing assets can lead to better investment performance. Effective diversification. Diversification involves spreading risk across different asset classes and within each class. By diversifying, the negative impact of a poorly performing investment can be offset by stable or well-performing investments. Effective diversification aims for the combined value of all investments to advance. A systematic investment strategy helps in achieving proper diversification, rather than random selection. Diversification does not mean investing small amounts in numerous options, as it can be counterproductive when considering transaction costs. The preferable approach is to have larger investments in a carefully selected few, utilizing a strategic diversification approach. Understanding correlation. Correlation measures the degree of relationship between two elements. Low correlation suggests a weak or minor relationship. High correlation indicates a strong relationship. Highly positively correlated stocks move in the same direction at the same times. Diversification is more effective when investments have lower correlation. However, it is important to prioritize smart share selection over solely focusing on low correlation. Building complex portfolios solely based on interrelationships may lead to mediocre results. Avoid purchasing bad investments solely based on their tendency to move inversely to others. It's crucial to remember that correlation analysis is based on historical data, and there's no guarantee of future relationships. Apply logic and evaluate if an additional element truly adds value to an existing portfolio. Compounding. Compounding results in exponential growth of investments over time. Profits generated by the investment are reinvested, attracting more growth and profits. The compounding effect leads to an amplified increase in the value of the investment. It is a long-term process that maximizes the growth potential of investments. The efficient market hypothesis. The efficient market theory explains why many investors fail to beat the market. It claims that no person or group can consistently outperform the market, assuming all investors act rationally, and process information correctly. However, the theory overlooks the fact that investors do not always act rationally and can be influenced by fear or greed. Market psychology during corrections or crashes can lead to irrational selling or overvaluing stocks. Investors may not process information simultaneously, leading to varying reactions and potential trading opportunities. Market price movements can sometimes be driven by investor overreactions to news, causing temporary deviations from a company's true value. The efficient market theory may not always hold true, allowing opportunities for investors to outperform the market. Exploiting situations where shares are perceived as overpriced or underpriced can potentially lead to market-beating returns. Consistently outperforming the market is difficult to achieve. Some investors believe that tracking the index is a more reliable strategy for long-term investment success. Be consistent. Sticking to a flawed strategy is not beneficial in the long term. A well-researched and reviewed strategy should be given time to deliver results. Consistency and discipline are key to successful investing, as demonstrated by experts like Warren Buffett and Peter Lynch. Warren Buffett's strategy did not allow him to invest in technology stocks during the tech boom, but he stuck to his principles. Despite criticism and poor performance at times, Buffett's consistent approach eventually paid off. It is challenging to stick to a plan when it appears to be failing, but having financial targets in place can guide decision-making. Following a methodology consistently may involve periods of poor performance, known as drawdown. Temptation to change strategies may arise, but understanding the strategy's historical performance and normal behavior is important. Drawdown. Drawdown refers to the period when the equity in an investment account declines due to losses. Lack of consistency in investment decisions can lead to underperformance. Following recommendations from newsletters, TV personalities, or magazines may be effective, but rigorous adherence is necessary to assess their effectiveness. A consistent approach helps investors detach from emotional influences in the investing process. Be patient. Patience is a crucial aspect of investing and trading, allowing time for the market to recognize the value of a company's shares and for profits to be generated and distributed to shareholders. Lack of patience and fear are emotional responses that can lead investors to sell prematurely or wait for confirmation in the press, missing out on potential gains. Patience is also important in short-term trading, allowing prices to trend sufficiently for profitable opportunities to emerge. Once a researched and implemented strategy is in place, exercising patience can contribute to success in trading. It's essential to assess personal experience, objectives, and financial situation, and consult with a broker or professional advisor before making trading decisions. Appropriate asset allocation. Asset allocation is the process of dividing your total capital among different asset classes. It involves determining the percentage allocation for shares, property, fixed interest, and cash. The goal of asset allocation is to diversify investments and manage risk based on individual factors such as risk profile, financial goals, and time horizon. It helps in spreading risk across different asset classes and potentially enhancing overall portfolio performance. Asset allocation should be reviewed periodically and adjusted as needed to align with changing circumstances and investment objectives. Your risk-reward profile. Understanding your unique risk-reward profile enables you and your advisor to select suitable investments that align with your requirements. Cautious investor seeks better than basic returns while maintaining low risk. Typically older investors aiming to protect accumulated wealth. Willing to consider less aggressive growth investments. Prudent investor seeks a balanced portfolio for medium to long-term financial goals. Requires an investment strategy that considers tax and inflation effects. Willing to take calculated risks for greater income and growth returns. Aggressive investor Willing to take higher risks for potentially higher long-term and short-term gains. Open to higher gearing and business risk. Views risk as an opportunity rather than a threat. Driven by the potential for capital gain. Willing to borrow money to invest. Portfolios are growth-oriented. Thanks for watching. Don't forget to check out our flashcards and remember to like and subscribe for more great content. Stay tuned for our next video. See you soon.